And so it is that input cost rising that is the theme of the day.
Input costs rising, oil prices still rising. We've got the perfect voice for you on all of this. Michelle Schneider's with us, Managing Director for the Market Gauge Group and author of the best-selling book, Plant Your Money Tree, A Guide to Growing Your Wealth. And more importantly, one of the first female floor traders over at the New York Commodities Exchange at the World Trade Center. And Michelle, therefore, with your experience, decades of it, I mean, particularly in the world of commodities, what do you make of the oil sort of story right now and how inflationary a push really it is?
Well, actually, relative to inflation, I read something very interesting today. Analysts at JP Morgan came out, and what they did was they looked at equities over the last 20 years and the rate of inflation, and this was excluding the big tech stocks, the big NASDAQ stocks, and actually amassed that oil should be trading at $115 a barrel relative to inflation. And so to me, that's fascinating for many reasons. One is I do believe that oil has more upside, and two is as we're looking at the inflationary numbers, oil has been relatively weak, especially as you're comparing it to food. And so what's happening right now with all the publicity about it and the blame game that's going on all over the place, if you look at it that way, it seems to me that we should get used to higher oil prices and then see what that does to the overall markets, especially with ESG and some of the other ones that have been underperforming in the energy space.
And so thinking about overall markets and the stock market in particular, what higher oil would mean, if you look at the energy sector, it's already come a long way in 2021, up about 51%, by far the best performing sector. I mean, even with higher oil, how much further could that group run?
Well, if we just take a look at the ETF XLE, and that's a good one because it represents a lot of the big oil companies. The two top weighted ones are Exxon and Chevron. It has already, as you said, really performed well, and it's come off recently to a pretty good correction. And interesting, if we just look at the chart, technically held critical support at the 200-week moving average at 54.50. So at this point now, if we use that as a barometer for the whole energy space, even with crude oil or Brent oil or WTI, whatever you want to look at, if that now takes out 60, I think you have some real concerns for the energy and oil market, but also probably a good opportunity if you're an investor and to get into XLE if you're not already in.
Big picture, if you're thinking about these equity markets, we know the old adage, it is time in the market, not timing the market. How are you thinking, though, about being invested when we're only 2 to 3% off of some of the fresh record highs?
Well, actually, I think there's a lot of talk about interest rates and the yield curves and short-term rates. But to me, what's actually really the most important to look at is how the long bonds or the 20-year plus bonds are doing relative to the S&P 500. For the ultimate risk-on situation, you want the SPYs to outperform the TLTs, and they are. So to me, at this point now, I can't get bearish. I look at this as a healthy correction. Obviously, that can change. But right now, I think what the market is doing, adjusting to the news and trying to figure out what's going to happen here if the Fed, now with Powell being reelected or re-nominated, is going to be less accommodative. And I say, really, right now, the market is saying not really if you just watch that long bond market. So we're still optimistic at this point going into 2022 until, of course, inflation really starts to go crazy. I don't even think we've seen the worst or the best, however you want to look at it, of inflation going into 2022.
Mish, therefore, how much higher do you see inflation going?
Well, just look at the food prices, and they're not abating anytime soon. If you just look at today, coffee has been rocketing, sugar's been rocketing, wheat's been rocketing, on and on and on. And so this is not something you can just point a finger out and say, stop doing this, because we do have Mother Nature at the helm, and she's going to do what she's going to do. And at this point, the trend definitely seems to be that with the underproduction we had coming into COVID, and now going into these real shortages of food and these higher prices, that if that continues to go parabolic, that's really when we start to see inflation wreak havoc. And then maybe at that point, you'll see things like precious metals start to go, maybe we need to rally here. And at that point, I think the Fed will really start paying attention.
And coming back to the energy markets in particular, I mean, you said at the start that given where inflation is, oil should probably be closer to $115 per barrel, that you do see more upside for oil What kind of number do you have in mind?
Well, at this point now, I would say 85. It just sort of topped out at 85 and it dipped down to around 80. So here we have a range, and I'm very much a range type trader when I like to see a range break out. We get through 85, I would say $100 a barrel is probably not unrealistic at this point, and maybe even relatively quickly. I think one of the things that's keeping oil down right now, too, is the closures that we're seeing again in Europe and some fear that demand's going to wane. We know that there's a surplus of supply, and we know that there's a lot of manipulation. But if that demand, or when, I shouldn't say if, when that demand comes back, that could be the surge in the oil prices.
Really appreciate your time and perspective, especially on a commodities day like today. Michelle Snyder, of course, Managing Director for the Market Gauge Group. And still ahead, you guys, Biden opting for continuity with renomination.